Hello and welcome to my channel. In this video, we are coming to look at the top 20 financial ratios that are used in accounting, finance, banking, investments, financial modeling, etc. etc. So what we are coming to do in this video is that we are coming to take a short but comprehensive look at each of these financial ratios that are useful in these areas of study. Alright, so why don't we get started, shall we? So if this is your first time on my channel, kindly subscribe to the channel by hitting the notification button down below this video, and also consider liking the video if you find it useful, and also why not hit the notification button so you can receive future videos as and when I get them posted. Alright, so as we know, we have categories of ratios in accounting, and these categories are 5. So we have 5 categories of ratios, and under each category we have specific ratios. So we are going to take a look at the category, and then we'll look at the ratios that fall under each category, and then we'll look at the formula and everything that we need to know when it comes to the interpretation of the ratio. Alright, now the first category is profitability ratios. Profitability ratios tells us how much the business is generating using certain metrics within the financial statements. So the general rule when it comes to profitability ratios interpretation is that if you calculate these ratios and the figure is high, then it is better. And how do we know that the figure is high or low? By comparing it with the previous year ratio, or with an industry average, or by the ratio of a competitor within the same industry. So that is how we analyze the financial ratios. Alright, so the first profitability ratio we'll be looking at is the gross profit margin, and the gross profit margin is calculated by gross profit divided by sales revenue times 100. So the value for this particular ratio is in percentage, and we know that gross profit is sales minus cost of sales. So what this ratio does is that it tells us how much profit in gross we are making on every sale that we make. So that is what we are calculating here. The second one that we want to look at is the net operating margin. And with the net operating margin, it is calculated as the PBIT, or what we call the profit before interest and tax. Then we divide that by sales revenue and multiply it by 100. And this particular one considers our profit after we have deducted our operating expenses, except for interest and tax. So this is how we calculate the net operating margin. The next one is the return on capital employed. So the return on capital employed is a very useful ratios when it comes to accounting and finance, and this is calculated by the profit before interest and tax divided by capital employed, and then we multiply that by 100. Now, what is capital employed? Capital employed is calculated by adding our shareholders' equity to our non-current asset liabilities, or we can calculate the capital employed by deducting our current liabilities from total assets. Now, this return on capital employed is actually telling us how much profit we are making on the capital or the equity we have invested in the business, and we are talking about how much have we invested in the business and how much are we generating on this investment. So that is what this ratio is calculating. Then we move on. The next one is the return on equity, or what you call the return on investment, so ROE or ROI, and we calculate this by the formula profit after tax divided by shareholders' equity, and then we multiply the result by 100. So this one is talking about how much we are generating on only equity. The return on capital employed is talking about our capital, which comprises the shareholders' equity plus the debt that we borrowed. But when it comes to the ROI, we are talking about the return on equity only. That is ordinary shares of the business. All right. Now we go to the fifth one, which is asset turnover. So the asset turnover ratio. This is calculated by sales revenue divided by capital employed, and we are talking about how much how often we are using our assets to generate revenue. So the higher the value, the better. Then the next one is the return on assets. The return on assets. So the return on assets, as we can see from the formula, this is asset turnover. So the asset turnover is actually net asset turnover. That's why we are using the capital employed. So that is the net asset turnover. That's how we can also call it. But when it comes to the return on assets, we are talking about our total assets for the business, as we can see it in our balance sheet. And then we also take our profit after tax. So we take our profit after tax, divide it by the total assets, and then we get our return on assets. The higher this value, the better. That means that we are using our assets to generate more profit for the business. All right. Now we go to the second category of ratios, and that is short-term liquidity ratios. So with the short-term liquidity ratios, we have the first one being the current ratio. And the current ratio, with the short-term liquidity ratios, we are talking about the ratios that are measuring the liquidity position of the business. How liquid or how often can the business pay its short-term debt when they come due. So with the current ratio, we are comparing our current assets to our current liabilities, and we are expressing it as a ratio. So what we are saying is that these are our current assets, the assets that are highly liquid or which we can convert into cash. And then the current liabilities, the amounts or the debts that we are supposed to pay within the shortest possible time. So when you compare these two values and you find them as a ratio, and you get a ratio of 2:1, then we are saying that your liquidity position is good or is acceptable. However, this depends on the specific business and industry you find yourself. Some businesses may have a current ratio of 1.5:1, and that is still acceptable. All right, so that is it. Then we move on to the second one, which is quick or acid test ratio. So with the quick or acid test ratio, it is an improvement on the current ratio. What we mean by that is that with the quick ratio or the acid test ratio, that's why we call it the acid test, because it is looking at the most liquid assets. It is comparing the most liquid assets to the current liabilities, and that is why we are deducting inventories, because inventory is considered the most slow. Now, the reason why we deduct inventories is because it is the slowest current asset item that we convert into cash. So when it comes to the conversion of the current assets, inventory is considered the item that moves the slowest when it comes to conversion into cash. So this is how we calculate it. And as a general rule of thumb, a ratio of 1:1 is acceptable. However, as I said, it depends on the specific industry or business we find ourselves. Then the third short-term liquidity ratio is the cash ratio. With the cash ratio, we are just considering the cash and cash equivalents, and then we are dividing that by the current liabilities. So with this, we are talking about, as it stands now, how much cash do we have to settle our current liabilities. So that is it. And as a general rule of thumb, 1.5:1 is generally acceptable. However, this is dependent upon the business and industry. All right. Then the last one that we will look at is the working capital formula. The working capital, what is working capital? It is the current assets less our current liabilities. So when you pick your total current assets and then you deduct your total current liabilities, the difference between those two figures is what we call the working capital. And this particular working capital is very important to businesses because that is what is being used to finance the day-to-day operations of the business. So that is it. The third category, okay, so before we go to the third category, please subscribe to the channel for more videos. Please like the video if you find it useful, and also consider hitting the notification button so you can receive more videos when they get posted. All right. Now the third category is what we call the efficiency ratios. The efficiency ratios are actually the ratios that are talking about our inventory movements, receivables, payables, and all that. So let's look at them. So we have the first one, the inventory holding period. Now the inventory holding period is talking about how long do we hold our inventory in store. So how long does our inventory take to get sold? So that's the inventory days, and this is calculated by inventory divided by our cost of goods sold. Actually, it is credit purchases. Okay, it's inventory divided by credit purchase. However, it is we rarely see credit purchases within our financial statements, and we all know that the cost of goods sold, a significant portion of this particular cost of goods sold is credit purchases, and so we decide to use cost of goods sold or cost of sales to calculate our inventory holding period, and then we multiply the result by 365 days. So a rule of thumb is that the shorter the number of days, the better for the firm. Why? Because if the number of days is short, it means we are selling our inventory more quickly than our previous year, or that the inventory, the average in the industry and all that. Now then, the next efficiency ratio is the receivable collection period, also known as the receivable days. So this one is talking about how long it takes for our receivables to be paid to us. That is the business. So how long does it take for our debtors to pay us? That is the receivable collection period. And we calculate this by taking the total accounts receivable in the statement of financial position and divide it by the sales revenue in the statement of profit or loss and multiply the result by 365 days. So as a rule of thumb, the shorter the number of days, the better for the firm. So that is how we deal with the efficiency collection period. Then we look at the payables payment period, or the creditor days, and this is the opposite of the accounts receivable collection period. So with this, we are talking about how long it takes for us, the business, to pay its creditors. That's why it is called creditor days. Creditor days. And we calculate this by taking the total accounts payable within the statement of financial position, and we divide it by the cost of goods sold within the statement of profit or loss and multiply it by 365 days. So when you calculate this and you have a longer number of days compared with the previous period, or that of an industry average or a competitor's ratio, then we say that it is better for the firm. However, there are implications to this, and that is where your research and other work is supposed to be undertaken. So in this video, we are just providing a summary of these ratios to help your revision, so that you can get them at your fingertips whenever you want to work with them. These are very important when it comes to financial modeling, when it comes to account interpretation of financial statements, when it comes to investment banking and all that. So These are very key ratios that you should master and should be at your fingertips before you go about your accounting or finance related tasks. All right. The next one is the cash conversion cycle. The cash conversion cycle, we take our receivable days, we add our inventory days, and then we subtract the payable days. So that is how we find our cash conversion cycle. And as a general rule of thumb, the shorter this number of days, the better for the firm. The shorter, the better. All right. Then our next category of ratios is the long-term solvency ratios. The long-term solvency ratios, and we want to look at the first one, which is the gearing ratio, or what you call the leverage. Now, when we talk about leverage, it is concerned with the mix of long-term debt and equity that the firm uses to finance its operations. That is leverage or gearing. Okay. Now, usually, most firms have a very high gearing ratio, and when we say a firm has a higher gearing ratio, we are talking about usually greater than 50%. So when you calculate this and you get more than 50%, then we say that firm is highly geared. It's highly geared. But interestingly, most firms find themselves in this category. However, the problem comes when your gearing level continues to increase. When that happens, what that means is that you find it very difficult to borrow to finance your operations in the future, and investors will also be unwilling to invest in your business because they believe that your business is at the verge of collapsing or being declared bankrupt. So the gearing ratio is a very important ratio when it comes to investment decision making in businesses. All right. Then the second one is the interest cover. The interest cover. The interest cover shows whether a company earns enough profit to be able to pay its interests comfortably. So the interest that the company is getting or is supposed to pay on its long-term debt, are we generating enough profit to be able to pay for that payable interest payable? If we are generating enough, then the company is in a very good position. So we, as a general rule of thumb, we say that a ratio of 3 times or more is usually acceptable. So when you calculate this and you get 3 or more, then this particular ratio is a good indication for the business. Then the next or the final category of ratio that we are coming to look at is the investment ratios. This is where the investors focus on the most. So the investment ratios. Now, the investment ratios are used by investors to make their investment decisions. That is whether they want to invest in the business or not. So the first one we are talking about here is dividend yield. And as we all know, dividend is what investors or shareholders get when they invest in a particular or when they buy shares in a particular business. So the dividend yield, they are always interested in how much they are going to get from the business, and this dividend yield is what tells the investor how much they are going to earn even before they invest in the business. So the dividend yield is calculated by dividend per share, which is our total dividend divided by our total number of shares outstanding, and then we divide the dividend per share or DPS by the market price per share, which is MPS, and we multiply the result by 100. So when you do this and it is high, then investors will be willing to invest in your business, and the opposite is true when it is low. The next one is the dividend payout. The dividend payout. Now, the dividend payout is talking about how much of the profit after tax we are going to pay in dividend at the end of the period. So that is the dividend payout. How much of our profit after tax is going to be used to be paid out to our shareholders at the end of the period. So that's the dividend payout. And the higher this particular ratio, the better. The higher the percentage, because it's in percentage. So the higher the percentage, the better for the firm. And then we also have the price to earnings ratio. Now, we also call the PE ratio, price to earnings, or the PE ratio. Now, this is, I would say, the most important investment ratio that we have in finance, because this particular ratio tells us the potential growth of the share price of the business we are valuing. So it is a valuation ratio. It's actually a business valuation ratio, and it also indicates the confidence that investors have in the business, that okay, when I buy shares in this particular business, then I know that by this particular ratio, I am expecting that the share price of this particular business is going to rise in the next 5 years, in the next 6 years, in the next 5-10 years. So this particular ratio indicates the growth prospects of the share price of the business, and we calculate it by the market price per share divided by the earnings per share, and then we multiply this by 100. Now the general rule of thumb is the higher this ratio, the better, because when the price to earnings ratio is high, then it means that the growth prospect of the share price of the company is also very high. So investors will be trooping in to invest in this particular, or to buy shares in this particular business. All right, then the last one we want to look at is the earnings per share. Now this is actually not a ratio. It's not actually part of the ratios, but it is helpful in calculating other ratios such as the PE ratio and the other ratios that we look at. So the earnings per share is actually our earnings before interest and tax, and we divide that by the total number of shares. So it tells us the amount per share that is paid, or that is going to be used to value the interest of shareholders or providers of funds to in the business. Yes. And in accounting, this earnings per share is actually covered by a standard IAS 33 earnings per share. So these are the top 20 financial ratios that we have. These ratios are very useful when it comes to financial modeling, interpretation of financial statements, when it comes to investments and banking and other related issues in finance. So these 20 ratios are carefully selected. I have carefully selected them because I know that they are very useful in these particular areas. So you can really watch this video again and again so that you can have a full grasp of the ratios. So thank you very much for watching my video, and kindly subscribe to the channel by hitting the subscription button down below this video, and also like the video if it was useful to you, and click on the notification button that is at the right hand side of the subscribe button, so you can receive videos as and when I post them. So thank you very much, and I will see you again in my next video.